At 8:17 a.m., Washington launched what officials believed would be a decisive economic strike against Canada. New tariff threats, tougher trade restrictions, and aggressive language were rolled out with confidence. The White House expected a familiar result: pressure Canada, force concessions, claim victory. Supporters praised the move as proof that America was finally negotiating from strength. Television commentators framed it as a bold attempt to reset an imbalanced relationship. But by sunset, the story had changed completely. What began as a campaign to squeeze Canada was quickly becoming a lesson in how economic power can backfire when it collides with reality. The logic behind the move seemed simple enough. Canada sends a large share of its exports to the United States. The two economies are deeply connected. Access to the American consumer market has long been a major advantage for Canadian businesses. If Washington made that access more costly or uncertain, Ottawa would be forced back to the table. At least that was the theory. It was clean, dramatic, and politically useful. But theories often look stronger in briefing rooms than they do in real markets. Within minutes of the announcement, investors began asking harder questions. How would U.S. manufacturers handle higher costs if Canadian inputs were disrupted? What would happen to auto plants dependent on cross-border parts? Would farmers face retaliation? Could energy prices move if supply flows tightened? How would businesses plan if policy changed again next week? These were not ideological questions. They were practical ones. And practical questions tend to move money faster than speeches do. The stock market reacted nervously from the opening bell. Industrial companies fell first. Transport names weakened. Manufacturers with North American supply exposure saw immediate selling pressure. Analysts warned that the administration might be treating a highly integrated economic partnership as if it were a one-sided dependency. It was not. Canada sells to the United States, yes, but the United States also relies heavily on Canada for crude oil, natural gas, electricity, aluminum, lumber, fertilizer ingredients, agricultural products, and countless components used in factories across the Midwest and beyond. This was not a clean pressure point. It was a shared system. Inside the White House, advisors initially dismissed the reaction as temporary market noise. They argued tough negotiations always create short-term volatility. Previous administrations, they said, had lacked the courage to use leverage properly. This time would be different. America would hold firm, and Canada would blink first. But Ottawa did not respond with panic. Instead, Canadian officials projected calm discipline. Emergency meetings were held quietly. Trade representatives consulted industries. Public statements emphasized sovereignty, resilience, and confidence. There were no emotional outbursts, no desperate appeals, no visible fear. That mattered. In geopolitical confrontations, composure can become a form of strength. The calmer side often appears more prepared. Business leaders on both sides of the border quickly grew uneasy. Auto executives warned that tariffs on components could disrupt production lines within days. Retailers feared rising prices. Agricultural groups worried about export retaliation. Rail and trucking firms began reassessing freight demand. Energy traders monitored cross-border flows closely. These industries do not operate on campaign slogans. They operate on contracts, schedules, margins, and certainty. And certainty was disappearing fast. As the day progressed, another problem emerged for Washington. Canada had more options than many assumed. Over the previous decade, it had expanded trade links beyond the United States, strengthened ties with Europe, increased access to Asian markets, and become strategically valuable in sectors such as energy and critical minerals. That meant pressure from Washington did not leave Ottawa with only two choices: submit or suffer. There was a third option: diversify faster. Once that possibility entered the market narrative, the White House strategy began to look weaker. International observers noticed too. Allies in Europe questioned whether close partnership with Washington could suddenly become economic vulnerability. Asian buyers saw an opportunity to deepen ties with a reliable supplier under pressure. Rival powers watched carefully for openings. America had intended to display strength. Instead, it risked advertising unpredictability. By late afternoon, the political message and the economic message were moving in opposite directions. Politically, the administration insisted it was winning. Economically, markets were signaling doubt. Stocks remained volatile. Analysts openly questioned whether the costs of confrontation would outweigh any concessions gained. Some warned that even a technical victory could become an economic loss if trust eroded and supply chains shifted permanently. That is the hidden danger of aggressive trade warfare: winning the headline while losing the structure underneath it. By sunset, the original plan was already unraveling. Canada had not folded. Markets had not applauded. U.S. industries were not cheering. Instead of looking cornered, Ottawa looked steady. Instead of appearing dominant, Washington looked increasingly reactive. The trade fight had backfired because it relied on an outdated assumption that one country could pressure another without hurting itself in an interconnected economy. But modern trade does not work that way. Pressure moves in both directions. Costs return home. Partners adapt. Confidence matters. What was meant to weaken Canada was beginning to weaken American leverage instead. And before the day was over, an even bigger complication was about to emerge. China was watching closely. When the White House launched its trade offensive, the expectation inside Washington was clear. Canada would feel immediate pain, business pressure would rise, and Ottawa would eventually return to negotiations on America's terms. It was presented as a show of strength and leverage. Supporters argued that the United States, with the world's largest consumer market, held all the cards. Canada, by contrast, was portrayed as too dependent on U.S. access to resist for long. But within days, that confident narrative began to collapse. Trump did not lose the Canada battle because America lacked power. He lost because the strategy misunderstood how modern economic power actually works. The first mistake was assuming dependence only ran one way. Yes, Canada exports heavily to the United States, but the United States also depends deeply on Canada. American refineries process Canadian crude oil. Factories rely on Canadian aluminum, steel inputs, lumber, fertilizer ingredients, and precision components. Auto manufacturing in North America functions through an integrated network where parts can cross the border multiple times before a final vehicle is completed. Grocery chains depend on seasonal agricultural flows. Utilities in some regions rely on Canadian electricity. Washington treated Canada as if it were a customer that could simply be pressured. In reality, Canada was also a supplier woven directly into the American system. That distinction changed everything. The second mistake was believing pressure automatically creates surrender. In some negotiations, that can happen when the target has no credible alternatives. But Canada had spent years quietly expanding those alternatives. Trade agreements with Europe opened new opportunities. Asian demand for energy, food, and raw materials continued growing. Canada's reserves of oil, natural gas, potash, uranium, timber, and critical minerals made it strategically valuable in a world increasingly concerned with supply security. Ottawa did not need to replace the United States overnight. It only needed enough options to withstand pressure and negotiate from a stronger position. Once Washington escalated, those options became more valuable. The third mistake involved timing. Global supply chains were already shifting after years of shocks. The pandemic exposed vulnerabilities. Shipping disruptions raised costs. Geopolitical tensions encouraged companies to diversify sourcing. Businesses everywhere were trying to become more resilient. In that environment, attacking a stable partner like Canada risked accelerating exactly what Washington should have wanted to avoid. Long-term diversification away from dependence on U.S.-centric trade patterns. Companies that once saw North American integration as automatic now had incentives to build backups elsewhere. Trump's strategy may have won headlines, but it also encouraged structural change. Markets recognized this faster than politics did. Investors quickly understood that tariffs on Canada were not a clean external punishment. They were a tax on integrated production. If auto parts become more expensive, manufacturers pay more. If lumber costs rise, home builders face pressure. If fertilizer inputs become pricier, farmers feel it. If transportation slows, logistics margins shrink. If uncertainty increases, capital spending pauses. The damage does not remain at the border. It flows inward. That is why Wall Street reacted nervously while political allies still celebrated. Money often sees practical consequences before governments do. Another reason Trump lost the battle was diplomacy. Public pressure campaigns can energize domestic supporters, but they often harden foreign resistance. No elected government wants to appear bullied by another country in full public view. Once the dispute became theatrical, Canada's room to compromise quietly narrowed. Political leaders in Ottawa could either submit visibly or stand firm visibly. Most countries choose the second option when sovereignty becomes part of the narrative. Washington may have mistaken public toughness for private leverage. They are not the same thing. Canada's response amplified the White House miscalculation. Instead of panicking, Ottawa projected calm control. Officials held measured briefings, consulted industries, and signaled that Canada would defend its interests while pursuing new opportunities. That tone mattered. Markets prefer discipline. Allies respect steadiness. Businesses reward predictability. By remaining composed, Canada made Washington's aggression look less like strength and more like overreach. The contrast was politically damaging. There was also the issue of credibility. Trade pressure works best when others believe it is strategic, consistent, and tied to clear objectives. If goals seem to shift, rhetoric changes daily, or escalation appears impulsive, confidence erodes quickly, partners begin hedging. Investors demand risk premiums. Even allies of the administration start asking what success actually looks like. In the Canada dispute, that uncertainty became a central problem. Was the goal tariffs? Better terms? Political optics? Domestic messaging? If no one can define victory, no one believes in the strategy. In the end, Trump lost the Canada battle because he treated interdependence like weakness. He assumed one side could inflict pain without receiving it, that alternatives were too small to matter, and that public confrontation would force quick submission. But modern economics rewards adaptability more than raw size. Countries with resources, stable institutions, and multiple trade pathways can absorb pressure and reroute around it. Canada did exactly that. What was supposed to be a demonstration of American leverage instead exposed its limits. The larger lesson was stark. Power is real, but it is not absolute. In a connected world, even the strongest economies cannot coerce partners without paying a price themselves. Trump entered the battle believing America held all the cards. He left it discovering the deck had changed. While Washington was locked in a bruising trade fight with Canada, another power was watching quietly from the sidelines. Beijing saw what many markets had already begun to understand. When close partners turn against each other, openings appear. The White House had launched pressure expecting Canada to bend. Instead, Canada resisted, markets turned volatile, and America's leverage looked weaker by the day. That is when China moved in. Not with dramatic speeches or public celebrations, but with something often more powerful in global economics opportunity. The first signals were subtle. Chinese trade officials began speaking more openly about stable commodity partnerships and diversified supply chains. State-linked analysts discussed the value of reliable energy imports and secure access to strategic minerals. Business media in Asia highlighted Canada's resource wealth, institutional stability, and export capacity. None of it sounded explosive on the surface. But taken together, the message was clear. If Washington wanted to push Canada away, Beijing was prepared to pull it closer. Canada had something China needed. Energy demand remained massive. Industrial growth required metals, potash, timber, agricultural products, and long-term resource security. Critical minerals used in batteries, electronics, and advanced manufacturing were becoming even more important in a world racing toward new technologies. Canada possessed many of them in abundance. It also offered a rule of law environment investors trusted, something not always easy to find in resource markets. To Beijing, that combination looked strategic. To Washington, it looked like a geopolitical complication that had not been fully anticipated. Quiet talks reportedly intensified around agricultural purchases, expanded commodity contracts, and future investment pathways. Chinese buyers were interested in more Canadian grain, food products, and energy supply. Discussions around liquefied natural gas and long-term procurement gained new relevance. Mining interests also drew attention as China continued searching globally for secure access to materials essential for manufacturing and energy transitions. None of these moves required a formal alliance. They only required commercial logic. And commercial logic was suddenly on China's side. Markets reacted almost instantly to the possibility of deeper Canada-China ties. The Canadian dollar found support as traders priced in stronger export optionality. Resource and transport stocks gained interest. Port infrastructure, rail logistics, and mining names saw fresh speculation. Analysts noted that Canada, once portrayed as vulnerable to U.S. pressure, was now being revalued as a strategic supplier with multiple suitors. That kind of narrative shift can be powerful. When markets begin believing a country has alternatives, pressure loses force quickly. Washington now faced a painful irony. The campaign designed to isolate Canada may have increased Canada's bargaining power by advertising its value to the rest of the world. Beijing did not need to win Canada in any dramatic sense. It only needed to widen Canada's choices. Every new contract, every exploratory investment, every future-facing discussion weakened the premise that Canada had nowhere else to go. In trade politics, optionality is leverage. China understood that well. There was also a diplomatic layer to the story. Beijing had long argued that American economic pressure tactics create instability and encourage nations to diversify relationships. The Canada dispute gave that argument fresh credibility. If even one of America's closest partners could become a target of aggressive trade action, then other countries might reasonably ask whether overdependence on Washington carried risks. China's answer was predictable: build multiple channels, reduce reliance on any single power, and keep doors open elsewhere. Canada's response remained cautious. Ottawa was unlikely to rush into any arrangement that created new dependencies or political controversy. Canadian leaders understood the complexities of balancing relations with both Washington and Beijing, but they also understood leverage. Simply having China interested strengthened Canada's position. It signaled that pressure from one side could be offset by demand from another. That alone changed the strategic equation. U.S. business leaders noticed the danger quickly. Some warned that pushing Canada toward deeper ties with China could hurt long-term American interests far beyond tariffs. Once supply chains shift, they do not always shift back. Once ports are expanded, contracts signed, and logistics systems built, new habits become permanent. The concern was no longer just about one trade dispute. It was about ceding influence through miscalculation. Media coverage intensified the contrast. Washington looked trapped in a conflict of its own making. Beijing looked patient and opportunistic. Canada looked increasingly valuable. The visual story was devastating for the White House. One side used pressure, another used timing. In geopolitics, timing often wins. The broader lesson was impossible to miss. Great powers do not always lose influence through defeat. Sometimes they lose it through distraction. While Washington focused on punishing an ally, China focused on benefiting from the fallout. While American officials defended tariffs, Beijing explored supply deals. While headlines centered on confrontation, strategy moved quietly in the background. By the end of the week, one truth had become clear. This was no longer only a Canada-US dispute. It had become a contest over who gains when allies fracture. Trump's trade battle was supposed to show American dominance. Instead, it created space for a rival to advance. Washington applied pressure. Beijing offered opportunity. And in global politics, opportunity often travels faster than force. The moment investors realized China was moving into the vacuum created by Washington's trade fight with Canada, markets reacted with brutal speed. What had started as a bilateral dispute was now becoming something much larger, a strategic loss with economic consequences. Traders were no longer asking whether tariffs would pressure Canada. They were asking whether the United States had accidentally handed a geopolitical advantage to its biggest rival. And once that question entered the market, money moved fast. Screens turned red across key sectors. Volatility surged, and analysts began repricing not just trade risk, but influence risk. The Dow Jones Industrial Average dropped sharply in early trading as industrial and multinational names led the decline. Companies dependent on stable North American supply chains faced immediate pressure. Investors understood that if relations with Canada worsened while China expanded commercial ties, American firms could lose both efficiency and strategic access. That combination is dangerous for earnings. Manufacturing stocks weakened first, especially those tied to automotive production, heavy equipment, chemicals, and construction materials. These sectors rely on predictable flows of inputs, cross-border logistics, and stable planning horizons. The S&P 500 followed lower as the anxiety spread beyond trade-sensitive names. Retailers worried about higher costs. Consumer brands feared margin compression if imported materials became more expensive. Financial firms faced broader growth concerns if business investment slowed. Once investors begin to suspect that policy confusion could weigh on the wider economy, selling rarely stays contained. Fear spreads from the obvious victims to the possible ones. That is exactly what happened. The Nasdaq experienced sharp swings throughout the session. Technology companies were not as directly tied to Canadian commodities as manufacturers were, but investors still sold many growth names because uncertainty affects valuation everywhere. Tech stocks trade heavily on expectations of future earnings. If global friction slows growth, increases input costs, or damages business confidence, those future expectations get revised downward quickly. Markets do not wait for certainty. They price probabilities. Bond markets send an equally important signal. Treasury yields moved lower as investors sought safety. That kind of shift often reflects a flight from risk rather than confidence in fundamentals. When money leaves equities and enters government bonds during a policy conflict, it usually means investors are preparing for slower growth or rising instability. In this case, both concerns were in play. The dollar traded unevenly as markets balanced traditional safe haven demand against worries over Washington's economic strategy. Meanwhile, the Canadian dollar found support, a humiliating contrast for the White House. The nation meant to be weakened was now being treated as increasingly valuable. Commodity-linked currencies and exporters also saw renewed interest as traders anticipated Canada could benefit from fresh Chinese demand. If Beijing wanted more Canadian energy, agriculture, or minerals, that had real pricing implications. Sector moves told the deeper story. U.S. auto stocks fell because supply chains depend on smooth U.S. Canada coordination. Mining and materials names were mixed, with some gaining on higher commodity expectations while others dropped on uncertainty around sourcing. Rail and freight operators swung sharply as investors tried to assess future shipment patterns. Agricultural companies moved nervously as traders weighed the possibility of shifting export flows. Energy names were volatile because deeper Canada-China ties could reshape future demand routes. Financial television exploded with urgent coverage. Anchors described the sell-off as a strategic market warning. Analysts debated whether Washington had underestimated second-order effects. Some argued the market was overreacting to headlines. Others countered that markets were doing what they always do best, pricing consequences before politicians admit them. One strategist summarized it bluntly: tariffs can be temporary, but lost influence can be expensive. That line resonated because it captured the day's mood perfectly. A Buffett-style lesson hovered over the chaos. Markets can survive trade disputes. Markets can even survive bad policy for a time. What they fear most is a strategy that creates avoidable openings for competitors while weakening confidence at home. Investors can calculate a tariff percentage. They can estimate supply costs. What they struggle to model is self-inflicted geopolitical drift. If a policy strengthens rivals, damages alliances, and creates domestic uncertainty all at once, the risk premium rises fast. There was also a powerful before and after contrast. Before the dispute escalated, the United States was seen as pressuring Canada from a position of strength. After China's interest became visible, the narrative reversed. Canada looked like a sought-after strategic supplier. China looked opportunistic and patient. Washington looked reactive. Markets are highly sensitive to narrative shifts because narratives shape expectations. Once investors believe momentum is moving the wrong way, they sell first and ask questions later. By the closing bell, some losses had narrowed, but the message remained unmistakable. Capital had delivered its verdict. The issue was no longer whether the White House could pressure Canada. It was whether Washington had damaged its own position by doing so. Markets were reacting not just to tariffs or trade numbers, but to a broader fear that American strategy had become counterproductive in full public view. In politics, leaders can debate who won the argument. In markets, prices reveal who lost confidence. And on that day, confidence moved instantly.